Contrary to common beliefs, generating sales turnover is not sufficient enough to succeed.
As a matter of fact, profits and cash are not synonymous.
To improve the return of a company and to limit its bankruptcy risk, you have to keep in mind 4 rules that we will develop in this module.
This module offers one chapter in which we will see the fundamental principles you have to keep in mind and the impacts of these rules on the balance sheet, SFP, and the income statement.
At the end of this module, a summary will be presented to you, as well as many quizzes to let you test your knowledge.
The goal of this module is to remember the fundamental principles of a good financial management.
To improve the return of a company and limit the bankruptcy risk, you have to keep in mind 4 rules.
The first rule is to decrease capital employed, as for example by manage the WCR, reducing DIO or DSO by accelerating collections or increasing DPO. Manage the CAPEX. Shall we invest? Increase the production capacity? As a consequence of its fixed costs will increase. Or is there any productivity optimization possible? Is there any alternative, such as subcontracting or outsourcing non-core activities? The second principle consists of optimizing the recurring operating income, in other words, manage sales, by relying on innovation and know-how and by wisely choosing carefully the products and the market segment to address. Manage the gross profit, thanks to the value creation perceived by customers. Manage the operating costs whilst keeping a certain operational flexibility, such as focusing on variable costs when reducing the production costs, etc. In order to test your knowledge upon the golden rules for an efficient management, I suggest you a little quiz. Shall we?
You have to say if the following statement is right or wrong.
Bankruptcy corresponds to a company's debt default.
Well done. You found the right answer. Debt default occurs when the cash and cash equivalents of the company and current assets are not sufficient to pay for the current liabilities.
You have to say if the following statement is right or wrong.
An increase in DPO decreases the cash level.
An extension of suppliers' terms of payment decreases the WCR and has punctually a positive impact on the cash position.